All right, good morning, ladies and gentlemen. Today is August 2nd, 2023, and I'm back with another edition of the live show. Quick edition today. Take a look around. Of course, the exciting news is that Fitch downgraded the United States credit rating last night, and that's interesting. So that's the big news of the day. And we finally might be looking at a little dip in the market. So last week when I was here, it was Fed Day, and they raised interest rates quarter point as expected, and the reaction to it was very muted. I thought the ranges were relatively small comparatively, and I guess it was, as they say, it was priced in, and no one really seemed to care. And then, of course, the market just, went on its merry way. However, there's something interesting on the chart here. So today I brought a candlestick chart. Oh, let me fix this. Let me fix this chart. You can't see the bottom scale here. Oh, I see what's going on here. There we go. Huh. Yeah, I usually go with my old standard open, high, low, close chart. So anyway, of course I got like all these chart setups in my little toolbox here, but so this particular day right here, what day was that? That was 7/27. Huh, I have to look back on my calendar. Okay, so that was the day after Fed Day, right? Is that right? 7/27. So let's see. Yeah, well, the 26th was Wednesday. So interestingly enough, if you recall, last week I said that in the past that Fed days back in the old days, a Fed day, like the market would rally, and then on Fed day, it would be like sort of an inflection point, and then the market would take a dip, right? At least temporarily. It would mark sort of inflection point in the trend. I've seen that so many times, especially back in 2019. Literally, the market would rally into Fed day, and then it would sell off after the Fed announcement for a week or two. You can check this, and then of course they'd buy the dip and rally it back up. But anyway, this is the old proverbial outside reversal day. So you get this sort of big run up, and then it's not just a bearish engulfing candle can happen anywhere, right? You see some. I don't really see too many on this chart for this time frame, but a bearish engulfing candle could happen like over here where there's no trend, but after you get a fairly significant trend and you get this outside reversal, then typically, according to most technical analysis books and just sort of common sense, right? You look at candlesticks, and of course it's not foolproof, obviously, right? I mean, the market actually, had Fitch not downgraded the credit rating, who knows? The last couple days we could, or today even, we could be eclipsing that what they call outside reversal pattern. But what's even more interesting is how the technicals and the fundamentals seem to line up at inflection points, right? Like this market kind of needed an excuse to sell off a little bit. Um, work off some of the overbought conditions. We looked at the RSI the past couple of weeks, and the RSI started getting pretty overbought, over here. And so now you got a negative divergence on the RSI, which I have on my other chart. But anyway, there's this particular chart. I have a 20-day, a 50-day, and the old 200-day moving average. And so interestingly enough, let me zoom back in here. So April and May, as I've been pointing out, like 2 entire months were just basically range bound for the market. So it wasn't much happening there. They were kind of boring, which is not necessarily typical, I guess, to see the market basically chop around in that big of a range in the spring. And then, of course, the latest, this latest sort of rally, which, started back over here, the trend line is kind of in jeopardy now, which is extremely interesting. So, I mean, you got obviously there's tons and tons of support. It seems like the sentiment has got a little overdone, right? Um, as long as I've been doing this over years and years and years, you run into these environments where the market just keeps going up and keeps going up, and nobody can think of any possible reason why it would go down. And of course, the bulls get real cocky, and I start questioning myself. I look at the news and all the macro type things, and I wonder to myself, well, geez, what is it that's just causing this, that's causing people to just continue to buy, and put more money in the market. And then, like I said, you could hardly think of any reason for the market to go down prior to this little downgrade, because it was just shrugging off any and all bad news. Like anything that you would think would sort of torpedo the rally, it just got shrugged off. And as you can see, I mean, we had a little tiny dip at the beginning of July. It was a few days, and then they just immediately snapped it right back up. And so, in June there was a little bit of a dip, and so here we are in August, and we might be looking at another little dip. Interestingly enough, as we speak, this trend line, which goes back to, May, right? This is sort of, this is one of those trend lines that the steeper the trend line, the more likely it is to get broken. This is the kind of trend line that could just get broken by the market just moving sideways, right? And so those are okay, but the idea is that a better trend line, like probably a more reasonable trend line. And here's the funny thing is that when you start drawing these lower trend lines, it's hard to even imagine that the market could pull back to here. But the thing of it is that this blue line's 20-day moving average, and so there hasn't been a whole lot of touches since there was basically no touch of the 20-day moving average in June, which is indicative of an extreme, robust rally. Even this little pullback here, you can see how extended it got from the 20-day, and so when it pulled back, it didn't even touch it, even though that was one of the more significant pullbacks we've seen in a while. This one looks like it sort of, might have kissed it right at the lows there. So, but you can see where we are right now, and so it wouldn't be surprising, honestly, unless we're in some sort of a new environment. Let me take this back to the beginning of the year. Hey, who knows? One of the things I want to talk about today is, of course, we know Apple's coming out with earnings after the bell on Thursday, and I think that's really going to sort of set the tone. And I actually saw a blurb about how Apple's sales growth, I guess it was the sales growth, is expected to contract for the first time since, like, I don't know, 2016 or 2006 or something like that, something crazy like that. So that's going to sort of set the tone. Depending on how the market reacts to what Apple says, that's going to set the tone for, going forward. But anyways, this is sort of the bigger picture here, or at least the year-to-date picture, I should say. And so, we'll have to watch this zone between the 20-day moving average, like this trend line in the 20-day moving average and this trend line in the 50-day moving average. And it'll be interesting to see how far down they sell this thing. The futures got a really interesting look because like 45.50 is like some sort of huge line in the sand, right? And which coincides, by the way, with the low of this outside reversal day. So this outside reversal day, and it's going to look a little bit different on the actual S&P chart, but because you can see on the S&P chart, it already looks like we're taking it out here. So that's going to be kind of interesting. Let me switch to my regular chart here. Let me see if I can find it here. There we go. Continue without. I probably should have saved all that, but yeah. So here's my regular chart. Let me. Oh, before I do pull this down, we talked about the RSI a few weeks back when it was, when it was way up here. Let's see. Yeah, it got up to like 75 or something. So we talked about it, back here, and then of course, we got a little bit of it worked off the overbought, but interestingly enough, that RSI, you can see there's a negative divergence on the RSI too, right? So the RSI peaked over here, and then the market, well, the market really didn't make a higher high other than that gap up open on the outside reversal day. So you get the outside reversal day. On this chart, I just have a 50-day and a 200-day. You got the outside reversal day, bearish engulfing candle after sort of a big run. And so, if technical analysis is any sort of guide at all, which I believe that it is, simply because the chart patterns to me has always been sort of like a road map, right? Like you can get to where you're going without directions or whatever. I mean, you can drive and wind your way to your location, but the chart pattern is kind of like the road map, and so I always look for repeating patterns. And I've never have put a whole lot into candlesticks. I've always preferred to sort of looking at the open, high, low, close, and I like to look at charts with hardly any indicators on. I like to look at the indicators, but then actually just look at the sort of the raw price action. And for me to interpret it in my mind, it seems to work better with these open, high, low, close charts than candlesticks. Although I do look through the candlesticks too. So anyhow, let's look at the SPY real quick because, okay, so see that candlestick was kind of throwing me off here, right? The big kind of line in the sand here. See if I can draw this on here. The big line in the sand is that low right there in the very, very near term, right? And so be interesting to see if we poke below that low. First of all, if we close below that low, I don't know if that's a straight line or not, but at this point right here, that's kind of a little bit. Now, here's the thing. I mean, it wouldn't or shouldn't surprise anybody that the market needs a little bit of a sell-off or retrenchment. The thing of it is that after a run-up like we've seen in June and July, so it's kind of interesting the whole calendar month thing. And by the way, this whole like significant rally we've seen really started on the calendar, which is another sort of fascinating thing. You remember last year was not a good year for the market, right? 2022 wasn't. And so when 2023 started, basically like right out of the gate in January, a lot of money came in and just bid the market right up. And then of course February and into early March gave a little bit of it back. And then of course, we had the 2 months sideways. So this current rally really started at the beginning of June, and it's interesting to me how because usually, usually there's some things that go by the calendar, but when you actually see like important turning points, literally, literally respecting the calendar, it seems a little odd, right? Like this, like I said, this current rally, look at it. At the end of May, it was just barely starting to poke out of these prior highs from February. So it was a long time before the market was able to finally take out that high. This high right here. There you go. And so, a little poke above it, poke below it. But then, boom, like literally right at the beginning of June with that gap up there, that started the the 2 month rally that we've seen. And so, here we are at the very end of July after 2 months of the market sort of rallying. It's kind of running out of steam here, right? The MACD, which I have on a different chart, just started to go into the red here on this outside reversal day. So basically, you had the RSI and the MACD, and probably I don't even look at stochastics anymore, but you had all those basically overbought. You had one of these sort of periods where the sentiment is a little bit stretched and nobody could figure out any reason for the market to go down. And so now we're set up for a little bit of a dip. So the big question is, how much of a dip do we see? And I'll tell you something interesting. I did the calculations yesterday. Let me go to see if I can remember this. I did the calculations yesterday for like a 10, the old proverbial 10% correction. And if I'm not mistaken, somewhere in this is about an 8 to 10% correction here, right? Somewhere like that. Will put you down near the 200-day, but 10% correction puts you down near the 200-day moving average. So let me see if I did that right. It's always interesting to, and sometimes, of course, you could draw Fibonacci's on here and all that good stuff, but real simple back of the napkin math. 4,600 times 0.9 puts you at 4140. Okay, so that's a little bit above the 4140. So just say, 8 to 10% correction put you in that sort of area right there, which quite frankly, from this juncture would seem like a meltdown. So just for the fun of it, 4,600 times 0.95, 4370. Whoop. So there's a 5% correction, 4370. And it's just, interesting to visualize, 5%, 5%, well, let's see, 3 to 5% is a dip, 5 to 10% is a pullback, and 10% is a correction, is how I kind of always perceived it. So there's roughly your 5% correction. There's roughly your 8 to 10% correction. And of course, you got the way that these, and nothing happens that fast. Although, hey, in the past we've seen some swift and severe sell-offs, but quite frankly, this market, the market needs a little bit of sort of retrenching. I talked about a cup and handle, I believe, last week or the week before, and you had the big 2021, well, the run up after the pandemic, basically. Right? You had this run up after the pandemic, and then you got the big giant cup, and quite frankly, a handle forming now would probably be reasonable. So interestingly enough, there's a few other interesting things on the chart. As long as I got these drawings on here, might as well go interestingly enough, the market has run into, and of course I screwed that up. There we go. Look at that. Pretty significant area of resistance from that first major run up in 2022, right? I believe this is when Russia invaded Ukraine was this sell off. So this, I think, I'm trying to remember. Obviously, interest rates were going up, and you had rate hikes and all that good stuff, and you got, and so here's another instance of the calendar, right? Market ran up, new all-time highs, and then as soon as the calendar flipped over the year, boom, it started selling off, and then of course Russia invaded Ukraine, and you got this significant sort of, big relief rally here in March, and that was really significant. And then so we've run all the way back up to that area. So there's sort of your big cup, and now what would seem appropriate would be a handle forming. So, but hey, I've seen so many of these things, and just because we get a little zigzag, like we just had a big zig, and if we get one of these little zags, like you can see a couple of them right there, what I'm talking about is like that sort of type of pullbacks like you see there. There's one there, obviously the big one here, and so just I knew that was going to happen. And so to see a little bit of a zag here wouldn't be shocking. It would seem shocking right now. These charts are a lot harder to draw on than my old ones. It would seem reasonable, quite frankly, to get, because it's been so long since we've seen any sort of, even right here, that was minuscule, right? That was last year, but we really only had one pullback this year from February into March after a run up. And of course, there's the real sort of primary trend line from a longer term standpoint. So anyway, it's all fun and games, but the most intriguing thing to me is the fact that the market needed an excuse to at least, well, the market needed an excuse to at least take a little dip. We hadn't even seen a dip yet. If they shrug this off, and they very well might. So real quick, let's see. Real quick, if I change this to a weekly chart, the last time, oh, I knew that was going to happen, was 2011. In 2011, and there was, what am I trying to do here? Oh, I'm trying to zoom out to, man, these charts are a lot harder to work with than the old charts. There we go. So let's just take, this is a weekly chart, right? So 2011 was, all this debt ceiling stuff and all this and that, and by the way, I mean, we just had the whole thing where they basically ignored the debt ceiling. I don't know that they I don't think they raised it. I think they suspended it. But anyway, back in 2011, same sort of thing. Debt ceiling, we hit the debt ceiling, and there was all this stuff, and Jesus, as I recall, didn't they shut down Washington for like a couple of days or something? A lot of political posturing, all that kind of stuff, and then finally, they raised the debt ceiling, but was it Moody's or S&P? One of the two, Moody's or S&P, downgraded the U.S. credit rating, and I believe that's what that big down weekly thing was. And so 2011 wasn't really the greatest year for the market, although by the end of the year it was sort of a temporary thing. It was a summer thing, and then by the end of the year, everybody forgot about it, right? So, and then look what happened afterwards. So, um, at some point down the road, and it could be next week, nobody's going to care about the fact that Fitch downgraded the U.S. Although, the reason that they did it, the reason should make everybody really nervous. But the simple fact of the matter is that this is an interesting chart. I mean, it's not very often that you go back and like sort of zoom in to, this far back, a decade, this is over a decade ago. But so there's your credit rating downgrade. It mattered for, a while, and then it didn't matter, and then look what happened afterwards. Pretty incredible, actually. So, all right, so moving on, let's see. I need to reset my charts here. So, go back to my chart here. Make sure everything looks good. All right, let's look at Apple, because when the earnings come out on Thursday, that's going to set the tone for what happens from here. So if Apple, and here's the thing is, like, how the news is always interpreted. If there's a positive reaction, this is what I'm trying to say here. If there's a positive reaction to Apple's earnings, then, that's going to set the tone for the market there. Look at that. It's going to be really interesting too, because I mean, this is one of the most persistent trend lines. Look at that. It goes all the way back to March. You can see here what I was talking about earlier about, how the rally really started, in January. Interestingly enough, though, that very first day was sort of, that was like kind of the shakeout day, right? I mean, it's just interesting to see, that is a bearish engulfing candle at the end of a downtrend that literally marked the low. And so go back. Wow, that's pretty amazing. Yeah, that's pretty amazing to me that the very first day of 2023, it's like they tried to shake out the last of the weak hands, right? And then boom, it was all up from there. I mean, that was just sort of a sideways correction from in February. February was basically, rallied up. This might have been earnings here, but that was kind of a sideways sort of correction. And then in March, man, it just took off. So I mean, as I say almost every week, the most widely held stock on the planet, biggest market cap stock, all that kind of stuff. So really super important. What's more important, obviously, than the actual numbers is how the market reacts to them. So that's going to be something. I saw something on so AMD reported last night, right? And I haven't really been paying attention to this, but the earnings estimates, right? So the news is they beat earnings estimates, and then I saw a chart of the actual earnings estimates, and I mean, it was incredible. Like, the earnings estimates looked like this, right? I mean, they're just coming down and coming down and coming down, and then, earnings estimates have been lowered and lowered and lowered and lowered, and then boom, they come out and they beat the lowered estimates. And so I suspect there's a lot of that going on in the market, but this reaction here is kind of interesting. Market needed an excuse to sell off. Whether it sells off remains to be seen. I mean, basically, we got a little yellow flag. Fitch threw up what I would call a yellow flag, and so nothing would surprise me. But what would actually surprise me is to see a real sell-off on volume. See, that's the other thing too, is the market seems like, especially like yesterday, and just most of July, recent, there's been a few exciting days, but it seems like the market is very lethargic. That it's just low volume and low participation, and there's days where I go out, go to the beach for a while, or go run errands, have lunch, and that come back, and literally the market's been trading sideways intraday for 2 hours, or you get this a little bit of action near the open, and then sometimes some action near the close, but a lot of the intraday price action is nothing like well, it's basically the summer doldrums like we've seen over the years. Typically July and August are the summer doldrums, and the market gets boring. There's not as much volume or participation, and so the thing that's kind of screwing with the market these days is these zero DTE options have kind of changed the dynamic of the market, it seems like. And so I read a few things on it, and so basically I think the gist of it is that when the market makes a move in one direction, then people start buying these options in the opposite direction for like sort of a mean reversion trade, and that's dampening volatility, which, by the way, I see people still talking about the VIX. Oh wow, look at the VIX, up 12% today. That's amazing. I mean, I couldn't tell you the last time I looked at the VIX because I almost never look at it. Let's look at the weekly VIX here. The VIX can spend long periods of time. This is a weekly chart. I mean, look how many years we're going back. As you can see, the VIX can spend a lot of time just bouncing around under 20, right? 20 is kind of the I guess, the psychological level. If the VIX is over 20, then that's, but I'm not sure that this is even useful anymore, right? Or maybe it is. I mean, maybe everything's based on the VIX, because you always hear about, them suppressing the VIX. By suppressing the VIX, they cause the market to go up, because I guess there's the old rule is if the VIX is low, then you buy stocks, you buy more stocks and keep putting money into stocks. But interestingly enough, look at the monthly VIX. Yeah. So I mean, we're in like sort of the typical range here, right? The VIX always spikes, and you almost have to look at candlesticks. And I should probably switch to my candlestick chart to to even look at the VIX, because these aren't colored in, but it's kind of interesting to see. So when the VIX gets down to 10, 12, it's obviously elevated this month, but when the VIX gets really super low, like the 2017, that was a memorable year. I mean, look at the VIX was just buried the entire year. I mean, there was a couple of spikes, but pops, but they weren't high. And in 2017, I mean, the market just sort of drifted up the whole year. So that's kind of interesting. Here's something else that's interesting. Let me go back to this regular chart here, and what I meant to show you, here we go. What I meant to point out here was the fact that, and I think I talked about this last week, how the Russell 2000, there's been a lot of action in the Russell here lately. And so there you go. The Russell ran right up into major, well, I wouldn't say major, significant overhead resistance, right? Russell rallied right up from the May lows, right? These lows here. And, you've heard me talk about this before. These recent lows here, March and May, these lows were just barely off the October low, unlike the other indices. And so that was kind of interesting right off the bat, because that was sort of, what I would call a negative divergence. You got the the S&P and the NASDAQ and everything's on a tear except for, the 2,000 smaller cap stocks, right? Still hanging around the lows. And then all of a sudden in June, another by the calendar thing, in June, boom, it just popped quickly. It was like 3 sessions here basically made all the difference in the world. Brought it right back up to where it had fallen from. Oh, I guess my phone ring is a signal to wrap this up here pretty quick. But anyway, so, it's interesting that all these technical levels and all these different sort of things, and, everything just kind of, it's like the technicals line up, for some sort of event, and then you get the event, which is the fundamental part of it. And that's pretty interesting how that works. And I've seen that so many times over the years where, where the technicals sort of, are telling you something, and then out of the blue, there's some fundamental thing that just comes out of the blue, and, typically it's major inflection points. I've seen that a lot of times. Like a touch of the 200-day moving average or a trend line break or something, but it's kind of interesting. So August is, generally speaking, typically over the years, historically, that was what I was looking for. August is historically not a great month for the market. I think, it's basically a flat month. So anyway, I think Apple is going to be the make or break for the market. So that's the thing to keep an eye on. And other than that, we'll see. We'll see what happens from here. So next week will be really interesting because that'll give all this weird stuff that's all of a sudden happening now at the beginning of August a little bit of time to play out. So join me back here same time next week, and we'll see how things played out and what to expect